Martin, the last few days we've gotten some indications from each of our guests as to how they got involved with StockCharts, and I'm sure a lot of our viewers would like to know, how'd you get involved?
Well, it was basically through Greg Schnell. I was talking at a CSTA conference in Calgary, and we were driving along one day where he was taking me to his house where I was staying with him. And he mentioned he was contributing to StockCharts. And I thought, well, that's interesting. And over the next few months, we started talking about that. And eventually, Greg suggested to Chip that we might benefit us both to get together. And so I met Chip at an IFTA conference where I was speaking in San Francisco. And that's how basically we got together.
So I know, you and I were talking a little bit earlier, and one of the stumbling blocks, I guess, you had when you came on with StockCharts was that your indicators, you had your own special set of indicators. That created a little bit of a problem, I guess, maybe at the very beginning.
Yeah, well, I had a weekly market letter I put out, and Chip suggested that maybe I might be interested in putting it on StockCharts and running for StockCharts. And I said, well, that would be great, Chip. But I've got these indicators that I use, and it would be really helpful if we could get those on StockCharts. And so Chip said, no problem at all. Had them up right away. And I thought today might be a good time to talk about some of these indicators. We won't have time to talk about all of them, but we certainly have to. We can look at a few of them.
Yeah, absolutely. I will say I think Chip made a really good decision bringing in your Pring indicators.
Thank you.
All right, go ahead. Take it away, Martin.
Okay. We just get organized here with the screen.
No problem.
Okay. You let me know when it's coming up.
I will.
Yeah, right now.
Yes, you got it.
Okay. But the first thing I wanted to go through was there are a number of these indicators, and they all begin with the symbol exclamation mark PR. So you can find out where these indicators are by putting up exclamation mark PR in the search button beginning, and you can see that they're all listed. So if you want to see a complete list, you move down from more results to PR. And they come up along with some other stuff like the prime rate, but basically they're the Pring indicators. And what I found out this morning when I was going through this was this mentions column over here. Because I thought, well, I'm going to spend a lot of time explaining how these indicators work today. But when I got onto this, I found out that the mentions also give you an explanation of the indicators. You click on that, and up comes an explanation of the Pring inflation indicator, which is what I'm going to be talking about first of all. And it's opposite the Pring deflation indicator. It also tells you how frequently it's updated, EOD, and then which public chart lists that mention this particular indicator. And if you've got a chart list, it tells you all the chart lists on which the indicator appears and all the commentaries on which it appears as well. So I thought that was a very useful piece of information to have. So let's go back now to the presentation and look at our first indicator, which is the Pring inflation index, I should say. And what this is a group of 4 different sectors or industry groups, S&P industry groups, and I combine them all into one indicator. And all the 4 sectors are inflation-sensitive sectors, things like oils and mines and gold mines and so forth. And where they all move in a similar direction, it's nice to get them in an index format so that you get in case one of them is not performing up to scratch in a particular cycle, you can get an overall feeling about what the stock market's saying about inflation, whether it's betting on inflation-sensitive stocks or against them. And one of the things you can then do is compare the inflation index to the CRB Composite commodity index, because that's really what they're dealing in. All these individual stocks are dealing in commodities. So when commodities go up, these stocks should be profiting from that. So one of the ways in which I use this indicator is obviously a very long-term thing. This is the monthly chart going back to 1995. But even if you're a shorter-term trader with a 2 to 6 week time horizon, it's always important to have an understanding of the direction of the main trend, whether it's going up or down. So that's why I look at these long-term charts to try and give me an overall long-term view about whether commodities are going up and going down. And obviously, I look at the CRB composite, but I look at what the stock market's saying as well, because I want to get both the stock market agreeing with what's happening with the commodity markets. So as you can see here, what I've done is one of the ways in which you can do this is to occasionally draw trend lines on both series, and when the trend lines are violated, that reinforces or increases the probability that the trend is reversed to the upside in this case, or the downside in this case. And that's all we're dealing with in technical analysis, is in dealing in probabilities. So the more evidence we can get in favor of a particular trend change, the stronger that signal is likely to be. One of the other things is, you notice I put some moving averages through this. It's a 12-month moving average, which I use most of the time for long-term charts. But you can see one of the problems with using the moving average is you do tend to get a lot of whipsaw signals in these jagged indicators, especially inflation deflation ratio. So that's why I like to look at the trend lines whenever I can. And you can see we've got, what, 1, 2, 3, 4, 3 or 4 sets of trend lines. And when they're violated, give you a good, powerful signal of a change in a reversal in trend. That doesn't always work out. And it's another point I want to make. These indicators I find that I'm going through today are very useful, but they're far from perfect. But they do add an additional dimension to the analysis. So you can see here, we saw an upside breakout in the CRB composite, an upside breakout in the inflation index. That should have signaled by rights a tremendously strong rally in commodity prices, but it didn't. So one has to be prepared for the fact that sometimes this analysis doesn't work, and come up with a game plan for reversing or unwinding those positions when it doesn't go as expected. In this case here, we were able to look at a couple of downtrend lines that were violated. These happen to be head and shoulders necklines, of course, because there's the shoulder, there's the head, there's the right shoulder, and the same thing over here. So fast forward to the current situation, you can see it's really interesting because the inflation and deflationary forces have really been in a trading range for the last, 3 years. And the direction they're going to break out, it's going to have a very important, it's going to be very important implications for inflation or deflation sensitive stocks. Inflation in this case being things like oils and golds and mines and so on and so forth. So right now we got a sideways trading range with a slight downward bias because we're below the 12-month moving average on both these series. And we're also below this, or right at this trend line on the CRB composite. So this is actually at a pretty critical position here. So that's the inflation index. And then we got the opposite, which is the deflation index, which is an index comprising stocks that do well at the beginning stage of the cycle during a recession, things like consumer staples, REITs, property and casualty companies, and things of that nature that are very defensive, and that a lot of them are interest sensitive. So when we look at the deflation sensitive, we find that gives you, when you compare it to the S&P, that in the long-term sense gives you some advance warning of weakness in the stock market. So for example, we have a peak in the deflation index up here and a peak in the S&P up there. So this is a chart that goes back to 1990. So a little bit of space means a lot. And so in other words, this was peaking, the S&P peaked in the beginning of 1994, and yet the deflation index peaked about 6-9 months earlier. And we see the same thing over here in 1998, that the deflation index peaked, but stocks didn't peak until 2000. And by the same token, at the market bottom, we see in 2003, 2002, October 2002, the S&P bottoms out, but the deflation index had bottomed out sometime before. So you can use the deflation index against the S&P to kind of identify when we're getting some weakness in the deflation index. It could well lead to weakness in the in the S&P. But by the same token, when you're at the bottom, a positive divergence is offering you some good vibes that the bear market in the S&P might be terminating. So in other words, we look at 2016, and you can see that it's moving in a sideways range here on the S&P, but the deflation index was making a series of rising peaks and troughs. So it was, and it never broke below its 12-month moving average, which again was a positive sign. Fast forward to the present, you can see the S&P's been in a kind of a widening trading range here since January 2018. So was the deflation index, but in the last couple of months, it's gone on to make a new high, a new all-time high, and it's suggesting that the S&P is like to make a new high as well down the road. So another thing we can do is compare the inflation index, the exclamation mark PRI, with the exclamation mark PRDI. And that is really the stock market's way of betting on whether we're going to have inflation or deflation, whether commodities are going to do well, or at the other end of the scale, whether bonds are going to do well. And whereas with the inflation index compared to the CRB composite, we don't get too much in the way of lead times. When we create a ratio of the two, then that ratio tends to peak out ahead of the CRB composite. As you can see, all these, and it also troughs ahead of the CRB composite. So you can see that in all these situations, these arrows are kind of pointing to the right. The sharper the angle they're pointing to, or the blunter the angle they're pointing to the right, obviously the longer the lead time. You see all the way through, you can get some idea. If you can figure out that the inflation-deflation ratio has peaked or troughed, then the chances are that the CRB composite is going to follow suit sooner or later. So how do you know when the inflation-deflation ratio is peaked or troughed? Well, one of the ways in which we can do this, and again, we're looking at it from a long-term perspective, is to take an 18-month rate of change of the ratio. When the 18-month rate of the ratio reaches the plus 50% mark and starts to reverse, that's when we get one of these red arrows. And you can see that pretty well all the red arrows, the solid red arrows, line up with peaks or in the ratio. There was one example where it didn't work out in 2010, 2011, where we got up to the 18-month rate of change to the plus 50% level, broke down back below it, and instead of reversing to the downside, the ratio moved to the upside. That's going to happen in life, but on balance, we've got how many? We've got 1, 2, 3, 4, 5, 6, 7, 8 signals here. 4 of them bullish, 4 of them bearish, and only one real failure. So when you look at the situation right now is one in which we haven't really been doing anything for the last year, and that's also reflected in the price. That the momentum has gone in a quiet trading band, and so is the ratio itself. But when the ratio breaks out one way or the other, I think that's going to be pretty significant. To me, it looks as if it's in the process of forming a kind of a double bottom, because here's one bottom and then there's another bottom here. But until it breaks above this trend line, we won't know that this is a double bottom. And of course, if it breaks below this low here at 2016, that wouldn't be too good from the point of view of inflation, but the point of view of deflation, it would be. So that's another point about following this ratio. If the ratio is in a rising trend, you want to be emphasizing inflation-sensitive stocks. If it's in a falling trend, you want to be emphasizing the deflation-sensitive stocks, the consumer staples and so forth, REITs and so forth, all the ones that tend to do well at the beginning stage of the cycle and when inflationary pressures are not very high. So that's one way in which we can look at the inflation-deflation ratio. Another thing is to just draw a trend line on the rate of change. And in this case here, we drew a trend line between 1995 and 1999, and it broke to the upside and was followed by a nice rally. And we see the same thing down here in 2016. So one of the things, this is an 18-month rate of change. So one of the things we can look at is if it's ever possible to identify really long-term trend lines. The longer the trend line, the more significant the breakout and the price move is going to be after that trend line has been violated. So you can see that we're setting up for a very peak here in 2008, and that's 11 years ago. So we've got an 11 years trend line here, which is still in force, of course, until the rate of change breaks above. But if it ever breaks above that trend line, which it will one day, that will signify a very strong rally in the inflation-deflation ratio, which would be a very powerful signal to move towards inflationary stocks and away from deflationary stocks, where the indication is that we should be right now, obviously, in deflation. So if this line gets violated and this one also gets violated on the upside, that will be the signal to move into inflation-sensitive stocks relative to deflation.
Hey, Martin.
Yeah.
Question. A lot of times when I'm looking at commodities, the CRB and so forth, I also take a look at the dollar and how the dollar's been performing, because as the dollar rises, the tendency is for many of the commodity-related areas to underperform the benchmark S&P. And when the dollar is falling, that's when we normally see the outperformance. So it kind of follows a little bit with your inflation deflation look. And so my question is, do you follow the dollar at all?
Oh, yeah. And I've got a special indicator on that, which I hope to show you in about 10 minutes.
Okay. I'm sorry. I jumped ahead.
No, not at all. That was a very good question, because most of the time you're absolutely right. When the dollar is moving up, commodity prices are pressured. When the dollar is moving down, it's bullish for commodity prices. There are exceptions where the commodities and the dollar can go up simultaneously, but they tend to be the exception. So you're absolutely right, Tom.
Okay. Thank you.
So I was talking about this very long-term trend line in the rate of change. And I just want to show you a couple of other examples of long-term trend lines that you can draw on the rate of change, on 18-month rate of change. This is because a couple of them are really interesting positions right now. This is the Shanghai Composite. And it's a monthly chart. And this trend line begins in 1997 and goes all the way through to 2006. And you can see what happened when that long-term trend line on the 18-month rate of change got violated. And it was also confirmed by a shorter trend line break in the price itself. The thing exploded. So the reason I'm showing you this chart is because the Shanghai Composite, as we speak, is right at this downtrend line just here. And it's already started to edge through this trend line, joining the 2015 top with the 2018 top. So we could be on the verge of a very important bullish setup here. And another reason why I'm quite excited about Shanghai is the fact that this is a secular uptrend line, goes back to 1996. Long trends give you very powerful signals when they're broken, trend lines. And this one was broken on the downside, indicating that probably Shanghai was going lower. But what happened was it reversed itself, and we're now back above the trend line again. So in other words, all the guys who bought in this period here and went short, I should say, are coming home with a loss. So they're forced to cover. And usually when you get a false move to the downside and it's confirmed by a new trend to the upside, which it is with this breakout here, you get a very powerful move. We've also seen that we've got this long-term trend line down here. So if it gets a little bit more strength, it's going to bust that trend line, and we're going to get a very, very powerful move, even though we had a pretty strong rally already on a long-term basis, because this is what we're talking. Chinese markets like to move much higher. Another example of this rate of change comes from the gold price. And you can see that it broke this downtrend line going back to 1988 to 2002. We see a similar break in the price from a longer-term trend line. And look at the huge move that followed that. And also there was a small base that formed. Fast forward to the current point, and you can see that we've got a trend line going back to 2011. Not as long as this trend line here, but certainly a pretty long trend line of 8 years. And it's still in force because we haven't broken above it. But you can see if the gold price ever breaks above this resistance trend line here, but I think it's around 13.25 or something on a month-end basis, that would confirm this trend line break and offer a very strong rally in the price of gold. Again, gold and the dollar tend to move inversely, so we're in the same dilemma you were talking about before, Tom. So getting back to the inflation-deflation ratio, the last chart that I show you on this, I wanted to point out that it's at a very, we saw that it was on a trading range on the monthly chart. This is a daily chart. You can see how it's now falling between these two converging trend lines here. And since when's this, last August or something, it's really not moved anywhere at all. So it's at a very, very critical level here. Breaks to the downside, we're going to see further deflationary effects. If it breaks to the upside, then of course that would favor inflation-sensitive stocks. So that's something to bear in mind. So I want to show you another indicator now. This is this one measures the bond market, and this one is the bond net new high indicator. What it does, it takes a universe of exchange traded funds and yields, prices and yields of various sectors, and figures out the percentage that's above its 40-day moving average and a percentage that's below its 40-day moving average, and takes a net result. So that when it's down here, it means that basically most bonds are trading below their levels 40 days ago, and when it's up here, most of them are trading above their level 40 days ago. So the idea here is that when it moves to an oversold condition, which I put at minus 1.5, and starts to rally, that's when it gives us a buy signal. And as you can see, all these buy signals, because we're basically in a secular uptrend for bond prices, all these signals were pro-trend signals, so they tended to be on balance accurate, until we come to October down back here last year, and you can see that the indicator bottomed and reversed from this oversold level at minus 1.5, and then subsequently broke above this neckline of this reverse upward sloping. Well, it's not really an inverse head and shoulders because this low is about the same level as that. But the point is, there was a battle between buyers and sellers going on, and it was the buyers that won the battle, and that was all we needed to know. Now we're looking at the same indicator, but now we're looking at the peaks. And because it's a secular rally, it's a long-term rally here that's taking place in the price, when we get short-term signals that would normally generate some kind of a severe correction, like they did here and like it did there when it peaked from above this extreme level at 345. When you're going on a contra-trend basis, that's the time when, if you're going to have a failure, that's the time when it usually happens. So in other words, this is a bull market we're seeing here, and these sell signals were short-term sell signals under the context of a bull market. And when that happens, that's the time when you tend to get your failures. So right now, it's at a very interesting point because it's at a record high. And that suggests to me that obviously it's still in a bull market as measured by the 200-day moving average, because it's still above the 200-day moving average. Long-term momentum is positive, and other long-term moving average positions are positive, like 12 months. So it's still in a bull market. So on the one hand, you can say that this is overbought, and we should expect to see a correction. But on the other hand, it's a signal of a correction within a bull market, so it doesn't have as much power. So basically, it's more of a signal for traders than it is for investors, because investors don't want to get out of this until we see some kind of long-term signal on the sell side. But as a trader, you don't know whether or not it's going to have some kind of moderate effect. So you probably want to be lightening up on bonds here, especially as I'm reading reports that in the first quarter or so, the public was rushing into the bond market and rushing out of stocks. But the public is usually wrong in these decisions. So that's something to bear in mind as well. So finally, on this chart of net new high indicators, I'll show you can use it for overbought and oversold reversals. You can also use it for divergence analysis. In other words, when the 7 to 10-year bond ETF, the IEF, makes a higher high here, and the indicator itself doesn't, that's a sign of weakness. And when it gets confirmed by you need some kind of a indication that the price is agreeing with that, and that would occur with a trend line break just here. And then we go over here, for example, where you get the opposite situation, where the price of the bond makes a new low, but the indicator has started to reverse, and it started to reverse from an oversold level. So you got a couple of pieces of information that the bond market is likely to reverse. It doesn't tell you how strong the move is or what its duration is going to be, just merely that you have been used to the price coming down, and now it's probably going to get into a situation where it's going to move up because there's positive divergence. So if we look back at the October summer to October period last year, you can see that the price of the bond went sideways, and the indicator made a higher low in October than it did back in April. And you also got a subsequent confirmation from the price in two ways. One, it broke above this trend line we saw in the previous chart, or the first chart on this indicator, and the other, it broke above this much longer downtrend line. So that's the second indicator, the bond net new high indicator. Now we have to move to next panel. And this one's going to be of interest to you, Tom, because it's got the US dollar, and underneath is my dollar diffusion indicator. And this one measures, looks at a universe of cross-dollar relationships. Because remember, when looking at the dollar index, it's got a 57% weighting to the euro. That's a very high weighting in one particular currency. So we want to get a broader view of what's going on with the dollar. So we look at this dollar diffusion indicator, which measures the percentage of this universe of cross-dollar relationships that are above or below their 40-day moving average. And so when most of them are below the average and starts to turn up, that's when we get a green arrow here, which indicates a buy signal, obviously, that the diffusion indicator was oversold, now starting to reverse to the upside. So that's a positive thing. And you can see in pretty well all these situations, you get some kind of rally. It doesn't tell you whether you're going to get something like this or just a more muted rally like that. But if it was coming down, it's certainly indicative of the fact it's unlikely to keep going down anymore when the indicator goes positive. So right now you can see that the indicator is in a bullish mode. It's not, we don't know how long it's going to stay in a bullish mode, but if it was up here at the 10 or 12 area, then we could be preparing ourselves for a potential reversal. But it's kind of a neutralish sort of reading just here. And that suggests that it's got more upside potential before it gets overbought. And then the dollar itself is above this support trend line here and its 200-day moving average. So that represents a very, very significant level of support, because it's the moving average represents support in its own right. And then you add to that this trend line, which also has a dynamic level of support. You add them together and you've got a very significant level of support. If that gets violated, that would not be good for the dollar because of that violation of that strong support. On the other hand, we got some resistance up here around 98. If the dollar index can rally above 98, that will cause a breakout to take place and will be very positive. So right now, the indicator itself is in a rising mode, and that suggests to me that we're going to see an upside breakout in the dollar. Certainly, when you look at the long-term measures of the dollar, like dollar relative to 12-month moving average, or long-term smooth momentum like the stochastic or the MACD, all that stuff is, depending on the time parameters you have, but the ones I use, the KST, for example, are all positive at this point. One other point I'm expecting an upside breakout in the dollar. One other point I wanted to make on this was that I've got this pink shaded area here, and that's indicating a primary bear market, because you've got at least a 1 year major decline taking place. So remember I was saying about contra-trend signals not working? Well, here's a great example here. We get a buy signal, which would normally get a solid green arrow. This one gets a dashed green arrow because it's a failure. Because it occurred, it was a contra-trend signal. It was a buy signal in an ongoing downtrend. And always remember that the trend, the prevailing trend, the primary trend, is always going to dominate what the characteristics of what happens on a short-term trend. So in this case here, we had a short-term buy, and the characteristic was it was a failed signal or a very weak rally. Here again, we're still in a bear market. We get a stronger rally, so I've given it a solid green arrow, but it really is not a great rally and probably should have a dashed arrow there. So bear that in mind. Now, another way in which you can use the dollar diffusion index on certain technical events is over here, where we got, once again, we got the dollar index. Actually, it's the bullish dollar ETF, the UUP, and a currency diffusion indicator, the same one we're looking at before. And one of the things I was mentioning before was when you get a whipsaw, you often get an above average move in the opposite direction of the whipsaw. So in this chart here, we've got three whipsaws: a break to the downside, a false break to the upside, and another false break to the downside. Well, if you get something like that, one of the things you want to make sure is you get a confirmation of the whipsaw. So in other words, here's the whipsaw, it breaks to the downside, then it breaks back again. How do you know that it's not still a valid break to the downside? Well, you wait for some kind of a trend confirmation from the price, in this case, a break above this trend line, or in this case here, a break above that trend line, or in this case here, a break below that trend line. But you can also introduce the currency diffusion indicator, because if it's likely to be a false breakout on the downside, you'd expect the market to be oversold, which it is. And number two, a breakout to the upside, if it's going to be false, you'd expect to see the oscillator overbought as well, which it is. And the same thing down here, another false breakout, and we saw the market was oversold. So when it's oversold, it's unlikely to go much lower, and therefore that breakout stands a chance of being false. I've got a couple of minutes where I can just show you another indicator, the last one I'm going to talk about today. This is what I call my bottom fisher, and it tries to identify bottoms in the stock market. So here's how it's constructed. This is a theoretical momentum indicator, a short-term KST, and I divide the momentum indicator into 4 different quadrants. Winter, when it's below zero and falling, which is as bad as things could get, what you might call the markdown phase. Then the beginning of the next bull move is in the spring quadrant, and then the market phase, which is I call summer, and then finally the distribution phase, which I call fall. So what I'm trying to do with this indicator is when you take a universe of stocks, in this case we're going to take the Dow stocks, and a majority of them is in this position here. The next place they can go is over here into spring. So the idea is that when the indicator shows a large number of stocks in this position here, and that starts to reverse, that typically is associated with a bottom in the stock market, and a small bottom. So this is what this indicator here, this is the B fish here. And because it moves inversely to stock prices, what I've done is I plotted this inversely, or the indicator is calculated inversely. So when a high number of stocks is in that winter position, you actually get a low reading in the indicator. So once again, when we go to it doesn't call tops, it just calls bottoms. So every time it comes down and it crosses its moving average from below the low level here, that's when you get a buy signal. It's not perfect by any means, as you can see from here and here. We had some failed signals, and we had a couple more here. I mean, it went up, and it's supposed to give you a buy signal for like 2 to 4 weeks, and I guess that succeeded. But it was nothing like this buy signal over here. So it's not a perfect indicator, but it does have a pretty good track record of identifying short-term lows when they materialize. So I think I'm going to stop there, Tom. And if you have any other questions, we could lead into them. Or
yeah, there were a couple questions in the room. First of all, great presentation. I think everybody is just kind of staring with mouth wide open at some of these indicators that you developed over the years. They're really fascinating. So great job there, and great job explaining it as well. But a couple questions. One, do you have any thoughts on the weakness in small cap stocks?
I don't follow that very closely, so I'm gonna pass on that.
Okay, fair enough. Another comment. Someone indicated you're the only analyst they know who actually tried to make indicators such as these. Do you have any suggestion on a possible ratio that would indicate stagflation?
Stagflation.
Yeah, I guess. Well, go ahead.
That's when the economy weakens and you have a lot of inflation.
Yes. Have you done any?
No, when you have a lot of inflation. No.
That was easy. That was easy.
And the reason is I've never thought about designing an indicator for stagflation. I'm more interested in whether commodities are going up or not, or bonds are going up.
Okay. Well, I mean, anytime you get high inflation with high unemployment and so forth, that's, kind of that I guess is where the question is going. Certainly, I would say based on what we're seeing in the market right now, we'd have nothing like that.
No, it's the opposite. It's the opposite.
Exactly. Let's see. There was one final question. I mean, given where the market is, we've had a huge rally off the December low. Is there anything in particular that you really like from a trading or investing standpoint?
Any specific area?
Yeah. Any thoughts on where, somebody who's listening, where you might want to look as based on what you're seeing in the market right now?
Well, if you can think of a long-term momentum indicator, let me just go back to, let's say this is not the short-term KST. Let's say it's a long-term KST. Obviously, you want to be buying groups or stocks that are here rather than over here, right? Would you agree with that?
I agree.
So the ones that are in this position here are things like utilities, REITs, gold shares, which can be a defensive play. Whereas over here, we've got quite a few stocks like the S&P itself. That doesn't mean to say that it can't suddenly start to turn up and then move immediately to summer. But when we get a bear market low, typically what you'll see is everything is concentrated in this area here that I'm circling. So what I would like to see, and the market certainly doesn't oblige me in any way at any time, is for a lot of the groups that are up here, like the S&P, to undergo a correction so they could come down more into this area here from where they could reverse to the upside and get more of a sustainable rally. But right now, as I see it, it's more the deflation-sensitive stocks which are doing better. As I say, the REITs, the consumer staples, that kind of thing. That kind of thing.
Awesome. Well, I do have to say this was a great presentation. Really appreciate you coming on and joining us this week. It's a special week here at StockCharts, and we certainly wouldn't want to do this week without you. Great work as always. And I do want to mention to everybody that you do have a show that's on Saturdays, the first Saturday of the month, 2 o'clock Eastern. So if you enjoyed Martin's presentation here, I would certainly encourage you to check that show out. First Saturday every month, 2 p.m. And Martin, it was a pleasure once again, my friend.
Okay, thank you, Tom.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com, and today we're going to cover candle glance charts. Here are the topics and the timeline for today. First, we're going to show you where you can access candle glance charts and how to create them. We'll go over the candle glance controls. We'll show you how easy it is to customize the indicators and change the duration. Then we'll take a chart list and show you how you can view that as a group of candle glance charts. And finally, we'll show you how to create a custom candle glance chart style. Creating candle glance charts. There are a number of ways to access the candle glance chart feature and create candle glance charts. I'm on the free charts page, and you can see at the top we have the main sections of the StockCharts website, and there's the link to the free charts page. On the right side of this page, you can see we have a link for candle glance charts. If you scroll down towards the middle of the free charts page, you will see a candle glance groups section. And you can enter up to 12 symbols there in the symbol entry box and click Go to create a candle glance group. Or you can select from the predefined groups that we have. You can also find candle glance links on your members page. So if you click the members link at the top, you will see you have a control center on the left. And if you scroll down to the charting tools, you will have a link for candle glance charts. Candle glance controls. This is a candle glance group for the 30 stocks in the Dow Jones Industrial Average. And the controls can be used to customize these charts. At the top, you can see all the symbols that are currently shown. Then we have the chart duration. So I can click that drop down to change the duration of the chart, and I can even change it to a point and figure chart. I can easily add an indicator to all these little candle glance charts, such as MACD here, and I can change the settings as I like. You can even sort by that indicator. If I sort by descending, when I click that, it'll refresh, and I will get the stocks with the highest MACD value at the top and the stocks with the lowest MACD value at the bottom. At the bottom, you can see all the symbols that are shown in the symbol entry box. You can change that, and you can enter up to 12 symbols separated by a comma for a custom candle glance chart, or you can select from the predefined groups on the right. Customizing indicators and duration. The default setting for the candle glance charts is for 2 months, and you can see there are 2 moving averages as well, a 20-day moving average in blue and a 50-day in red, and you've also got some volume. Now these are clearly for some short-term analysis because they only go back for 2 months, but you can also do longer-term analysis and say make a cut. In other words, you've got a bunch of stocks here, 30, and you want to get the top 10, say. And the way you could do that would be to go to 1 year on duration. You'll get a refresh and you'll get a 1-year chart. And you can see which stocks are clearly in uptrends and which may be turning around here like Chevron. You can also add a relative performance indicator like the scooter. And if you add the scooter line and then you sort by descending here, then you will get the top scooters at the top. So if you wanted to focus on the top 10 stocks in the Dow, you would see them at the top here by sorting by the scooter. Viewing chart list in candle glance format. StockCharts users can also view a chart list as a candle glance group. So here I am in a chart list called Stocks, NASDAQ 100. And if I click the View All link, I will get 10 charts per page. And then up at the top, I have View List As, and I can select from that drop down there and choose Candle Glance. And then I will get 30 charts per page, and I can customize this page using the options at the top. Chartists can also view a chart list in Candle Glance format by going to the Members page. So here I am on the Members page. And if I go to my chart list, by clicking that link, I will be taken down. And there you will see all of your chart list. And I have a View List As drop down, and I can choose Candle Glance from that drop down to see that list in Candle Glance format. This is very handy for scrolling through dozens of charts in a short period of time. Creating a Candle Glance chart style. Most indicators are available on the standard Candle Glance workbench here, but if there's a particular indicator that's not on there that you want to see, or if you want to change the chart style that you're viewing in the Candle Glance format, then you can create a custom chart style for Candle Glance. And so I'm going to go down here and click on the Amazon chart to open it up in the Sharp Charts workbench. And what you would do is set that chart how you would like to see it as a Candle Glance chart. So here I've got a 9-month bar chart with the 50-day moving average, the 200-day moving average, and I added the Chan Trend Meter because I want to see that on my Candle Glance charts. You could also add the RRG indicator or any other indicator that's not shown on the standard Candle Glance workbench. So once I've done that, I need to create a chart style called Candle Glance. So I will click the Add New link and I will go Candle Glance. And then I will add that chart as a chart style. So now when I go to View All and I choose to view the list as Candle Glance, all these Candle Glance charts will now show a 9-month bar chart with a 50-day and a 200-day moving average and the Chan Trend Meter. And again, this is very handy. It makes it very easy to scroll through dozens of charts and quickly see setups that you want to investigate further or that you want to pass on. And just one note, when you're using a custom Candle Glance chart, you will not be able to sort by that particular indicator. And that concludes this instructional video for Candle Glance charts. Be sure to check out our other instructional videos, and thanks for watching.